Texas Roadhouse stock, ticker symbol TXRH, one of my favorite dividend growth stocks right now. But is TXRH also a buy at current prices? The stock has gone up 9% year to date, which is quite a difference with the S&P 500, which is down 15% year to date. Despite the odds, TXRH beat earnings on the 27th of October. Analysts are expecting that they will beat in the upcoming earnings as well. 22 analysts voted for a beat while only 1 voted for a miss. In the past 4 couple of quarters, TXRH had beaten both EPS and revenue, so I'm feeling quite comfortable since these were tough periods for a company like TXRH. Another reason why I love TXRH is because of the dividends. Right now it's sitting at 1.87% and the growth rate is at 16%. During the first lockdown periods they cut the dividends, which was a smart move in my opinion. So we have a great start with this stock in my opinion. But does this also mean that Texas Roadhouse stock is a buy at current prices? Well, in this video I'm going to show you real quickly what TXRH does. The most recent earnings, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Texas Roadhouse do? Texas Roadhouse is a restaurant company operating in the casual dining segment. The company's operating segment includes Texas Roadhouse, Boba 33s, and others. It generates maximum revenue from the Texas Roadhouse segment. If we dive in the most recent earnings, we see a lot of interesting things. Revenue is up 14.3% year over year, which is pretty good in my opinion. But more interesting is the income from operations, which is up 22% year over year, and the net income, which is up 18.5% year over year. Both are up significantly higher versus the revenue, which is a good thing of course. Next to that, I really like to see the double-digit growth numbers here. Diluted earnings per share are up 23.7%, which is also very nice. And this also has to do with the share buybacks. One of the most important metrics for a restaurant are the comparable sales. A restaurant can easily increase revenue by opening a new restaurant. And don't get me wrong here, you want them to open new restaurants of course. But next to that you also want them to grow in comparable sales. In the most recent quarter, comparable sales increased 8.2%, which is very nice. The average weekly sales were at 129, of which 12.6% were to-go sales, up from 120 prior year, of which 15% were to-go sales. So to-go sales is decreasing a bit, which is also quite logical with the lockdowns periods that happened before. A thing that I don't like here is the restaurant margin. It decreased 26 bps. Restaurant margin was negatively impacted by commodity inflation of 8.8% and wage, and other labor inflation of 7.7%. 5 company restaurants and 2 international franchise restaurants were opened, which is also good in my opinion. And the company ended the quarter with 185 million of cash on hand and debt of 75 million. And to me this is very interesting. Most restaurants are struggling with high debts in general, but also because of the lockdown periods. TXRH can pay down all their debt, which is very nice. For the 2023 outlook, the company is expecting to have positive comparable sales growth again, which is very nice of course. Approximately 30 new Texas Roadhouse and Bubba restaurants. A weekly growth of 5% excluding the impact of potential franchise acquisitions, commodity cost inflation of 5 to 6%, and wage and other labor inflation of also 5 to 6%. Overall, I'm quite happy with this outlook. And now that we know more about this company, it's time to check the fundamentals of this stock to see if it's a buy at current prices. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Texas Roadhouse is a 6.5 billion market cap company with a PE ratio of 24.98, so let's call it 25. This could mean that they are slightly overvalued. Later in this video I will show you my 3 price targets for TXRH, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 3.9 billion, and in this graph we see that it's going up quite nice and steady. And of course there's a decrease during the lockdown periods, but after that it recovered pretty well, to be honest, so this looks very good to me. Net income is at 263 million, which gives us a profit margin of 6.7%, which is above the 5-year average of 5.8%. So that's looking really good. On top of that, for a restaurant business, margins are looking really good, so this is something that I really like. EPS is up very nice and steady in the long run. Pretty much the same story as with the revenue growth. And again, a small decrease during the lockdown periods, which is very logical. Other than that, it looks really good to me. Price to sales ratio is at 1.73 right now and looks pretty good to me. The only thing that I don't like here is the fact that it's increasing over a longer period of time, but right now it still looks good. Price to book ratio is at 6.6, which is too high in my opinion. But keep in mind that the restaurants have a higher price to book ratio in general, so it doesn't worry me that much. But keep an eye on this number since it's increasing over a longer period of time. Price to free cash flow is at 22, which is a little bit too high in my opinion. I prefer 20 or lower, but this doesn't worry me that much. And in a moment I will show you why. But first, the analysis expectations. They expect EPS to increase quite a lot in the coming years, from 50 to 18% every year. So this looks really good to me. Revenue is expected to slow down in the coming years, from mid-double digit to low single digits. Return on assets is sitting at 9.7%, which is very nice for a restaurant business. And it's the same story with the return on equity, sitting at 26%, which is also really good. But the most important number here, return on invested capital, is sitting at 25%, which is insane for a restaurant business, so this is something that I really like. On top of that, it's significantly higher than the 5-year average of 12.8%, which is already pretty good. Current ratio is at only 0.45, which is very nice for a restaurant business. So again, this comforts me a lot. Current ratio can be defined as a liquidity ratio that measures a company's ability to pay short-term obligations. Another thing that I really like about this company is the total debt. Earlier in this video we saw that the company has 185 million cash on hand and debt of 75 million, meaning they can pay down all their debt and still have some cash left. And in this graph we see that total debt always had been very low, and during the lockdown periods they issued a lot of new debt. But this is very logical for a restaurant business. Right after things cool down, they pay down big chunks of their total debt again, leaving them again with almost no debt. So for a restaurant business this looks really good and comforts me a lot, since most restaurant businesses are struggling with debt. And it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in this graph we see that free cash flow is going up quite nice and steady, with 2 decreases which are again related to the lockdown periods, so it doesn't worry me at all. Another thing that I really like are the shares outstanding. It's decreasing over a longer period of time, but I would like a bit more steadier and consistent pattern here. Nevertheless, it's still looking good. And to me it's very important that shares outstanding are decreasing, since it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we are talking about dividends anyway, Texas Roadhouse pays a 1.87% dividend yield, which is pretty decent. Annual payout is at $1.84 and payout ratio is at 46%, meaning 54% left in cash to pay down debt, buy back shares, open new restaurants, acquisitions and all other things. I prefer payout ratio to be below 50%, so for now it's looking good, but keep an eye on this number. The 5-year growth rate is at 16%, which is also very nice. They have no dividend increase streak in years, but this is because of the dividend cut during the lockdown periods, which was a smart move in my opinion. After things cooled down, TXRH started to pay dividends again. Overall, a great looking scorecard. But how about the historical returns versus the S&P 500 and some competitors? I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include Wendy's and Wingstop. On the 5-year chart, we see that TXRH and Wingstop outperformed the S&P 500 big time. TXRH had a 105% return including dividends versus the S&P 500 at 68%. Wendy's performed similar to the S&P 500 and Wingstop had the highest return with 408%. On the 1-year chart, we see a 20% return for TXRH, while the S&P 500 returned minus 9.6%. Wendy's returned almost 12%, and Wingstop did pretty decent with 6.5%. On the 6-month chart, we see an almost 24% return for TXRH versus the S&P 500 returned minus 1.6%. Wendy's returned also 24% and Wingstop had a 106% return. On the 1-month chart, we see that TXRH returned flat versus the S&P 500 returning 8.5%. Wendy's returned 12% and Wingstop returned 9.6%. Overall, I think TXRH did very well. They have beaten the S&P 500 in every chart, which is pretty interesting given the fact that lockdown periods had a big influence on the restaurant industry. But does this also mean that TXRH is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 9%, 11% and 13%, since these are the numbers that look the most justified to me based on historical averages, but also on analysis expectations and future outlook. Profit margin, I'm filling in 6%, 6.5% and 7%. For the free cash flow margin, I'm filling in 6.5, 8.5 and 10.5%. For the PE ratio and price to free cash flow, I'm filling in 18, 20 and 22, since I want to pay a higher multiple for this company. I wouldn't say they have a moat, but to me their business fundamentals looks really strong and better than most competitors. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, TXRH is at $98. I hit analyze and we do see a lot of green numbers. We have a low price target of $75 to $81, and we have a mid price target of $101 to $132, and we have a high price target of $135 to $202. So if you believe these mid to high numbers, then TXRH could be a buy. To me, the mid price target looks the most realistic one, meaning $101 to $135, leaving you with a potential 30% profit in stock price. Based on the PE ratio, there's not much growth there. My final conclusion with this company is that it's worth the premium stock price. The business fundamentals looks really good, and I really like the fact that debt is very low for a restaurant business, and there's still a lot of growth potential for this company. Right now I have a small position in this stock, and I will increase my position over the coming months since it's a great dividend growth stock in my opinion. I wouldn't mind if the stock price decreases a little bit to maybe $80 or $90, since this will increase the margin of safety, but for now I'm happy to buy at this price. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.